Governments tell you they are working for your financial freedom. They promise stability, they pledge growth, they speak of equal opportunity. Yet, when history is examined with care, a far more unsettling picture emerges. For centuries, states have used economic instruments not merely to govern societies, but to shape the direction of wealth itself, and more often than not, that direction has been upward. These methods are not new. Their names change, their language evolves, their presentation becomes polished and modern. Yet the mechanism remains the same. Resources are drawn from the many, risks are socialized, and returns accumulate among the few. Let us begin with the oldest instrument of all, the debasement of money. When a state spends beyond its revenues, it faces a choice. It can openly raise taxes and accept political backlash, or it can quietly erode the value of its currency. The second option is less visible, and often far more effective. The Roman Empire offers a classic example. Faced with rising military expenses, it gradually reduced the silver content of its coins. On the surface, nothing changed, but inside the value was shrinking. Wages may remain the same. They may even rise, but when purchasing power declines, real poverty begins. It was a transfer of wealth, without ever calling it a tax increase. By the Middle Ages, the strategy had evolved. Monarchs demanded loans from merchants to finance wars and palaces. These loans were rarely voluntary. Refusal could mean punishment. The official language spoke of duty and patriotism. But in practice, capital flowed upward. Repayment was delayed, or made in money that had already lost value. By the 17th century, borrowing became institutionalized. Governments issued bonds. Investors lent money to the state in exchange for guaranteed interest. That interest was funded through taxation. Risk was minimal. Returns were secure. But who ultimately paid for those returns? Broad segments of society, through indirect taxes, government debt became one of the safest investments in the world. Wealth holders prospered. The fiscal burden dispersed downward. In the modern era, the structure appears more complex, but the logic remains unchanged. Budget deficits are routine, borrowing is framed as growth, public investment, employment programs, social support, these form the visible narrative. Yet large portions of spending flow toward defense sectors, corporate subsidies, and financial rescues. The 2008 financial crisis made this dynamic clear. Financial institutions took excessive risks. When the system faltered, public funds stepped in. Banks were stabilized. Markets recovered. But taxpayers absorbed the cost, and when the dust settled, the financial sector was more concentrated than before. Risk remained private. Losses became collective. Monetary policy reinforced the pattern. During crises, central banks expanded the money supply. Asset prices surged, stocks, bonds, and real estate soared. But who owned these assets? Mostly upper-income groups. For households without significant investments, comparable gains never materialized. Inflation plays a central role here. Nominal wages can rise, but if prices rise faster, real income falls. Inflation also reduces the real value of government debt. That benefits the state. For citizens, it means diminished purchasing power. In this sense, inflation often operates as a hidden tax. Pension systems follow a similar pattern. Contributions are rarely stored in separate reserves. They are used for current expenses. Future benefits depend on future workers. When demographics shift, strain becomes inevitable. The common response: raise retirement ages, reduce benefits, or allow inflation to erode their real value. Regulation tells a similar story. Laws are framed as public protection, yet powerful corporations often influence the rules meant to regulate them. Complex legislation burdens smaller players. Large institutions adapt. Competition shrinks. Markets concentrate. Complexity itself becomes a shield. When systems are too intricate to understand, accountability fades. This picture is not one-dimensional. States provide infrastructure, security, and public goods, but history shows that economic instruments shape power as much as stability. The essential questions remain. When a policy is announced, who benefits first? When crisis strikes, who is protected first? History does not repeat exactly, but its patterns persist. When currency is debased, when debt expands, when risk is socialized, outcomes tend to converge. Burdens spread across the many. Security concentrates among the few. Breaking this cycle begins with awareness. Look beyond the headline. Examine consequences, not rhetoric. Financial freedom begins not with income, but with understanding. If this perspective made you think differently, follow the channel and support the content. Here we go beyond the headlines and examine what lies beneath them.